Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory environment, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Kevin Davitt, Head of Index Options Content at Nasdaq, and Eric Metz, Chief Investment Officer at SpiderRock Advisors, to discuss market sentiment and what index options activity may be signaling. It is great to have the both of you with us as always. Eric, great to see you. And some recent measures, Eric, point to a meaningful increase in bearish investors and a decline in bulls. You at SpiderRock Advisors interact with a variety of people that have money in the markets. So based on your conversations late last year and early this year, do you think that sentiment is starting to shift here?
Yes, and first and foremost, Jill, thanks for having me. I think it is, and I think it is for a few reasons. Capital markets have been so good to so many people, and equities in particular, having, on the heels of 23 and 24, some tremendous returns. Obviously, in the growthy sector, Nasdaq specifically, but even more concentrated, right? You can call it Mag 7, but it's even a little bit broader than that. I do think with new policy in motion, I do think with the new administration, I do think with what I'll call maybe an overextension in some, I'll call it overconfidence from investor sentiment, that any blip in the horizon here could escalate and create some change in sentiment fairly quickly, right? VIX has percolated up and around 20 here, maybe 3 times. I think we're approaching that even closer today. That's on the S&P. The Nasdaq equivalent's doing the same. But I would also, like to think about where interest rate policy is affecting all of this equation, right? And so there's been a ceiling maybe at a 5% threshold. You add all this up, and investor sentiment is certainly changing. And I think could change quickly if you were to see some capitulation.
Yeah. And Kevin, from your perspective on sentiment, what are you seeing from the index options activity?
Well, like Eric said, thank you for having me back, Jill, and so good to see you, Eric. I love seeing the continued growth at SpiderRock. I have to tip my cap as somebody that kind of advocates for the strategic use of options. You've done it for clients for years, and the wind is at your back. But Jill, your question about the sentiment shifts in the market, I am, of course, aware of whether you're talking about the AAII Bull Bear Survey. Things like that have shown a shift more recently. Now, on the flip side, I would caution that those readings can be noisy, and the past couple were arguably influenced by both the DeepSeek news and probably more recently the prospect of tariffs early this month. So the way I tend to choose things and view things is looking through the lens of index options. And visually, what I did was look at longer term option volatility when the NASDAQ 100 was trading at all-time highs at 2 different points in time recently. So what you see is the volatility skew for NDX on December 16th, so 2 months ago. That's in gray. And then again on February 19th, that's in teal, which is earlier this month. And in both cases, the NASDAQ 100 was making new highs. Now, we're looking at skew for options that expire in December of this year, so roughly 1 year in duration. And when people like Eric and advisors that look to use options, they will often look at the December cycle to manage portfolio risk on an annual basis. Now, what I'd call attention to is the fact that on the most recent high earlier this week, the volatility for out-of-the-money puts was about 1.5 vols higher than it was in December. And then by contrast, the 15% out of the money calls settled with volatilities about a 1.5 vols lower than December. Now, what that tells me is that demand for wing type small delta puts has moved higher. That could be a sign of concern. Beyond that, the demand for out of the money call exposure has either waned, or there are more people willing to sell those types of options to finance potential protection. For those conversant with options lingo like Eric, the index volatility skew has steepened for longer dated options. And I do think that's reflective of increasing concern, whether it's driven by interest rates or headline risk or what.
Yeah, it's interesting, Eric, we're hearing about protection here. And the old saying is something along the lines of hedge when you can, not when you have to.
Yep.
And typically you can when vol is low, which has been the case in 2025. So Eric, are you're looking at different ways that you're establishing hedges at this point?
Completely. And to Kevin's point, the beauty of options and their usage is they can be completely dynamic with respect to what the market's given you at any point in time. And so as Kevin's outlining, I'll call it an increased skew, all that's doing from our work with our clients is taking advantage of that and then altering the shape of hedging or the shape of portfolio construction accordingly. So again, like if I think about markets hitting all-time highs even this week and the levels of volatility and the cost of protection, the cost of protection by itself is relatively high given, I'll call it the new highs in the market. Usually when you're hitting new highs in the market, volatility is low. Jill, you just kind of highlighted that. I think the difference here is it's not as low as maybe some previous all-time highs, but because of that elevated component, the skew that Kevin just outlined can be used to an investor's advantage. You need to know how to deliver that. And so our work is taking in our clients' outlooks, regardless of bullish or bearish sentiment, and then positioning our work to optimally solve for what it is they're trying to protect for. And so, we're staging hedges 6 months out, 1 year out, sometimes even in laddering, but put spreads are how we encapsulate that skew component that Kevin just hinted at, given the, I'll call it moderately elevated levels of just baseline vol here at all-time highs, or at least previous to the last 2 days.
Yeah. And Kevin, from a volatility standpoint, and I don't think I've ever asked you this question because we have not had a prolonged period of volatility, despite some of, if you look at a longer term chart, what happened with COVID. But when you think about 2025, we're having this conversation right now. How would you characterize it? And how far or how long do you think this is sustainable?
Yeah, one, Eric sort of echoed the point on the variety of ways that you can potentially craft exposures based on shifts in volatility. And I think that's one of the bigger reasons that options and index options in particular continue to grow. Now, I love those kind of questions about volatility. We talk about it in one way or another, a whole bunch of ways. And I think a little background can help give context here. So our group, the index options team, will track both realized and implied volatility levels for a variety of time frames. Eric was talking about 6-month tenors, 1 year, further out, laddering them. Now, if we're talking about realized volatility on an annualized basis over the past decade, the Nasdaq 100, which is what I care about, has realized a volatility in the ballpark of 19%. Now, by comparison, the S&P 500 realized volatility has run around 15.8, so a little bit below 16%. Now, that includes higher vol years, like you mentioned, 2020 with the pandemic, 2022 with the interest rate concerns. Now, I realize that the sample size here is very small. And I would point out that the data was run before today's sell-off. When you get roughly 2% moves in the market, that will pick up volatility measures quickly. But realized Nasdaq 100 vol coming into today, annualized out at roughly a 6.5% vol, and on the S&P side, it's like 4.5%. My point here is that realized vol has been exceptionally low early in the year, despite a couple of days where there was headline risk. And maybe that's changing now. So from my perspective, the expectation would be that that's not sustainable. And I think in large part why you haven't seen a measure like VXN or VIX, which Eric was referencing, and that always being forward-looking, fall below something like 17.5 on the VXN or like 15 on VIX. And historically speaking, I'd like to point out that it's very typical to get drawdowns in the range of 12 to 16% during any calendar year. And whether we're starting one of those right now is beyond me. But to the point of hedging when you can and not when you have to, today is one of those days where hedges should be working.
Yeah. And Eric, let me ask you this question in a different way. So if you put on your forecasting hat, what do you think is going to drive capital markets for the remainder of 2025?
Yeah. Listen, I want to tie in what Kevin outlined. The floor of volatility is higher today than normal, given all-time highs. I want to make sure everybody's cognizant of that. And what that really means is, yes, cost of insurance is higher, but the reason is there are so many macro forces in play today that, yes, some were there last year, some were there the year previous, but you add it all up, you have tariffs, you have geopolitics, you have a new administration, you have uncertainty. all that does is raise the level of implied vol, which is different than realized vol, which Kevin hinted at. Now, that dislocation, implied vol high, realized vol low, that can persist for a while, but it's costly to maintain positions in a hedging regime with that environment. So you do get some dislocation and some opportunities there. But Jill, to your point and your question, what is our outlook here? Without saying a macro forecast of like the direction of equity markets in general, uncertainty is clear. And until we have inflation under control, until the Fed can, I'll call it, be data dependent and really clearly message what the interest rate policy is. I mean, we're just so reactionary to those two forces. You couple that with geopolitics, you couple that with a new administration, uncertainty is not going away, right? At least for the foreseeable future, call it the rest of this year. And so I think in that light, portfolio construction needs to encompass, I'll call it, a measure of risk management, arguably more than ever. And again, we're sitting here so fortuitous that equity markets have done so well. It's just prudent more than ever to take this into your portfolio construction and your daily, I'll call it, build out, both for individual clients, but even more broadly on models and larger mandates. The other thing I would think about here is when you think about drawdowns, Kevin mentioned 12 to 16% drawdowns. Again, if I look back the last 10 years, equity markets, especially in the growthy sector like a Nasdaq, have compounded very, very well, like north of 15%. S&P, I think, is at 12. Forward-looking capital markets expectations across all of Wall Street don't have anything in that zip code. And so what that typically is going to mean is we might not go up 6% a year as some forecasts have us on average for 10 years. You're going to see down 20s, up 26. And the volatility of that ride matters, especially as you think about retirees, right? The sequence of returns matter. And again, where our core work is delivering value for clients is to solve the unique instance and objective per client need, retirement and scope, drawdown management and scope. But volatility has been historically suppressed really since the GFC, as the Fed has really invoked QE, and that's unwinding.
Yeah, and that was to my point earlier. We do have a generation of investors, for all intents and purposes, that have not really traded or invested through a prolonged period of volatility. It's almost as if, buy the dip has been gamified. Let's call that over the past 5 years. But there really is a need to be able to, whether, you're within the option space or not, to understand what these metrics mean, because it can signal a lot more than just what you're pricing in the volatility market. I mean, Kevin, to put a neat bow on this, right? This conversation is very different than it sounded in January. And to Eric's point, this could be one of those inflection points within the market where volatility did signal a change in sentiment.
I fully agree. I think the way that Eric expressed that, and the fact that when you think about the graying of America, the huge number of retirees, that sequence of returns can matter a great deal. Now, the younger demographic, that's less the case, but your point about them potentially not moving through a period where you had persistent volatility, as opposed to the V-shaped recoveries that we've seen for the better part of the past 5 years, is a very real thing. Now, I'm not necessarily saying that that's in the cards, but what I am saying is over longer time frames, it's bound to happen. And Eric's point about the flexibility when you understand how to incorporate volatility via the options market into a broader portfolio is hugely empowering. And broadly speaking, I think that's the tailwind for our business generally. And I'm glad to know that we have people like Eric out there explaining as well as he does how this stuff can work.
Yeah, me too. Appreciate both of you.
Appreciate that, guys.
As always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Appreciate it, Jill.